This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk here on this Tuesday, June 28th. Great to have you with us once again. Thanks for making us part of your day. I'm your host, Jesse Allen. Today's show brought to you by our friends at Growmark FS, and we appreciate you making us part of your day and being here with us today as we have a lot to talk about the market trade. Looking at Tuesday's trade action, we saw green pretty much across the screen in grains, with Minneapolis wheat being the exception. A little bit of lower activity in livestock today, and we have plenty to discuss. Let's say good afternoon to Jim McCormick with agmarket.net. Jim, great to have you back on the program, sir. How are you?
I'm doing well, Jesse. Thanks for having me on. I appreciate it.
Well, Jim, let's dive right in and talk about today's action. And, a lot of green across grains today. I think a lot of folks are pointing to various stories in the news, kind of moving the markets here in recent weeks, one way or another. You got weather, you have inflation, recession concerns, etc. We have reports coming up. But as you look at the grains today, what was your big item that really stood out to you that kind of moved us into the green here today?
I think the big story today, folks, was the fact that China is pretty much trying to come out of their COVID lockdowns. China has been very, very strict. When they see COVID in areas, they're pretty much shutting down cities and towns. And when I mean cities, I'm talking cities 30, 40, 50 million in population. So they're really starting to let down the restrictions that's been announced in the last 24, 48 hours. That has brought a lot of commodity buyers into the markets. The bean market was probably by far the strongest of the grain complex today. But you also saw some strength in some of these other markets, in the energy markets, some of the soft markets. All an idea is that now that China's come out of these COVID situation, they're going to start rebuilding their stocks. And to do that, they're going to come into the United States as one of the suppliers.
Well, Jim, as I look at things as well, and you talk about China there, and we look at these markets and we look at the cash markets as well, I know we've seen some of these inverses really get spread out in corn and beans, and that was another thing that I think folks were talking about today. I think it's like, a 90-cent inverse in corn and a little over $1 in the soy complex right now, and that's kind of an interesting dynamic, I think, as well.
No doubt about it. I think what you're seeing right now, part of the inverse you're looking at is the July contract. Now, July contracts go into delivery on Wednesday. So if you are a short trader right now, and you're short these positions, and you do not have the beans to deliver or the corn to deliver, you're feeling the pressure to cover that position. Right now, there are no deliveries anticipated. If you look at how tight the cash market is, both those commodities around the country, I don't think you're going to see anybody make deliveries. So I think you're forcing a little bit of squeeze in the short market on the old crop, plain and simple. New crop, on the other hand, was higher, but it's definitely lagging because overall, when you look at the forecast at this point in time, there's nothing really serious out there. It's not a perfect forecast by far. There's no doubt about it. There's some dry areas, Jesse, parts of Indiana, Ohio, as well as parts of western Iowa and Nebraska, to kind of point out a few that are missing out on the rains, and they will definitely like to see some rains. But if you look at the maps that are coming out, even the new map that came out right now, it is painting a picture of maybe slightly above normal temps, but everyone gets maybe a shot of rain over the next week to 2 weeks, which is kind of critical going to pollination. So, we haven't got the rain yet, so it's keeping the market from falling out of bed. But like I said, with enough rain in the forecast, it is limiting the buyers of the new crop commodities.
Well, Jim, as well, you mentioned the weather, and we have, of course, coming up here the USDA acreage quarterly grain stocks numbers on Thursday. I know the trade is focused on that as well. It's another item. Last week, agmarket.net, you guys released your acreage estimates. I wanted to touch on those a little bit because just looking through corn, beans, all wheat, everything looked a little bit pretty much in line with USDA, but maybe a little bit higher. So talk about those numbers that you guys got and how you got those findings last week.
Well, we're at about 89.7 million acres. The trade guess is about 89.86, so we're very close to the trade. Bean acres were at 91.1. The trade right now is at about 90.45. and wheat acres are at 47.4, and I think the average wheat test for all wheat is 47.01. So we're a little bit higher. Plain and simple, we think we lost some of the smaller grains came to the grain prices, as well as maybe the cotton kind of moved into those acreage. So that we lost a little bit there. Pick it up on, like I said, on the corn, beans, and spring wheat. In general, though, we're not looking for a big game changer on the acreage side of the equation. You know, 500,000 one way or another is really not going to probably make the change. It's going to be yield. It's, you lose a couple bushels of beans, a couple bushels off the bean yield, you can cut that carry out in half. Same situation for corn. You take 3 or 4 bushels off the trend yield. And remind you, Jesse, the trend yield they're using is 177, which would tie the best crop ever. You could also see this corn carry out drop below 1 billion bushels potentially. So the yield is really going to be effective. The other thing we're kind of looking at, it isn't near as exciting to talk about, is this quarterly grain stock report. But by historical norms, we've seen some very, very wide moves generated from these numbers. I mean, right now, what's interesting is that for the corn specifically, the average trade guess is about 230 million more bushels of beans. 230 million more bushels of corn are on hand compared to a year ago, which seems a little bit odd when you look at how hot the basis has been around the country. So we'll see where it's at. There's a range I was looking at, 379 million bushels between the high guess and low guess for corn stocks, and bean stocks roughly 360 million. That's more than the carryout. So the reality is the trade really doesn't have a good handle on what these stocks are going to be, and that could lead us to some very volatile trading when these numbers come out on Thursday.
Well, you couple the numbers, whatever they may be, along with, you mentioned the weather, and then heading into the 4th of July holiday. And this is always typically a very volatile time frame in the markets, with a lot of, changing and moving around. And then you get the long holiday weekend with the weather forecast, etc. It really does kind of shape us up for a very interesting dynamic, and one that I would have to think producers really need to kind of just be on their toes and be flexible here, and hopefully, maybe able to work on change their plan if they need to, just slightly, heading through these reports and through the holiday weekend, Jim.
No doubt about it, Jesse. I mean, the one thing you look at, I think the more and more the trade we get into the summer, if we do not, it's going to get harder and harder to take out the early summer highs. That is just the reality of it. The emotional peaks seem to have taken a toll. I mean, the reality is we've seen a lot of spec money come out of our markets recently. Some of it has to do with the weather. The weather has kind of cooperated, but some of it, the reality is this. Why do we draw a lot of money into our markets? We drew the spec money in because of the inflationary play. As the inflation story really took hold the last year and a half, the way a lot of investors kind of hedged off that inflation risk was to buy commodities. That's traditionally what you do, and it worked well. Crude oil's pushed to 130 briefly on the night of the war, beginning of the war. Corn, beans, and wheat all traded right at or just shy of all-time highs. Well, since that has happened, the Fed is now starting to raise interest rates. What are the Feds trying to do, Jesse? By raising interest rates, what are they trying to do? They're trying to drive down demand. You make things more expensive. You get it more expensive to borrow money. You tend to tamp down demand. If you tamp down demand, what are you essentially telling the funds? You're telling the funds, essentially, you're fighting the Fed. Fed's goal is to drive prices down, so I think you're seeing some of that come down. So it's going to be very hard, I think, to take out the summer highs unless the weather really, really starts to take a turn for the worse. So the producers have probably got to kind of change their psychology, or instead of maybe a kind of a speculative buy the dip mentality, we'd recommend kind of getting more of a try to sell rallies and start putting a floor into this market. Because if the weather does cooperate and all of a sudden we're worried about more of a recession, a deflationary type of situation in the markets, the odds are, unfortunately, that the markets will go lower into the fall.
Well, and as well, on the recession side, another thought that I had that I wanted to ask you about, we've seen cotton continue to move sharply lower, and that's usually a recessionary type move, but also copper. The copper market is, a lot of folks have been talking about how that's been an indicator of recession for, I think the past 30 years or something like that. I mean, you look at some of those markets, what are your thoughts there and how those are going to correlate into the overall commodity picture, Jim?
Well, I think you look at those are kind of your canary in the coal mine, to be quite exact. I mean, copper, they just call copper Dr. Copper. It is kind of when the economy is booming, we're building, we use a lot of copper in wiring and housing and, industrial production. So when that's going down, it's telling you the demand for that product's going down, and that's going to probably put us in a recession. I believe the odds, unfortunately, are we're probably going to go into recession. I think the Fed's got a very hard time essentially sticking the landing without a recession. I don't think it's going to be a deep recession, but I do think we're going to kind of slow down the economy. If you slow down the economy, you slow down demand for products, you slow down demand for pork, slow down demand for exports, and essentially it will trickle down, and that will have a negative impact on commodities. Cotton, I think, is a very classic example. If the world thinks we're going to go into recession, people are not going to go buy new sheets, they're not going to buy new clothes traditionally, and that's why the cotton market's in a free fall. And if anybody who hasn't looked at a cotton market, I would encourage you to look at it, not to freak you out, but just to kind of remind you what happens when you take some of the spec money out of the market. And like I said earlier, I do believe some of the spec money has come out of the grain market, but it is not all completely come out of the grain market. So we got a worst case scenario that the market really got kind of nervous about the economic recession or just downfall like we saw in 08 combined with weather that's cooperating. We do think this market could break. So we're encouraging producers to definitely be a little bit more aggressive in marketing grain. If you're nervous about it, consider buying some August short dated calls against it. That'll cover you in case the weather does turn bullish come out 4th of July weekend. On the other hand, if you're a little bit worried that maybe you're the reason why the market could go up because you're a little bit dry in parts of the Western Farm Belt, then maybe consider going with an option of a put where you at least put a floor under your equity to leave the top side open in case prices go up, or for some unfortunate reason you were not able to produce a crop and you're the reason why the market went up.
Jim, let's talk livestock. Hog market here today felt like we're just consolidating a bit lower, some nervousness in that trade ahead of Wednesday's quarterly hogs and pigs report numbers. Is that your general sense that you got from the hog market here today?
I think it's a general sense, exactly, and a little bit of disappointment. We saw some strength early in the day of the hog market on this China opening up from COVID, but it just did not sustain the rally. Historically, the CME index tends to top in late June, so that's kind of working against us right now. But yeah, a little bit today is more consolidation from the hog and pig report. Cattle markets is still concerned about inflation and the cost of gas, although it is coming down a little bit. That's got people worried about demand. The other thing, plain and simple, is it's hard to believe we are in the 4th of July weekend. We're moving into that dog days of summer, and just traditionally, as you get into the latter part of summer, you tend to see the demand for beef go down. And I think that combined just the traditional weakness in demand as you get to the hotter days of summer, combined with the higher gas prices, that could be kind of a drag on the proteins market.
Cattle side, feeder cattle lower today. Not surprising there with the higher feed prices, the rebound in grains today. But it felt like feeder cattle maybe spilled over into the live cattle trade as well as we wait for some of that cash activity here this week. Is that your thoughts on the cattle market? What are you seeing on that side of the equation, Jim?
Well, I'm a little bit worried about the cash. Like I said, I think as we get past the holidays at this point in time, I think you've got to be a little bit concerned about consumer demand. And I think that could tip the cash to the downside. Feeders, like I said, they didn't like the inflationary hype, and then like the higher corn prices. Whenever you see that, you tend to get a little bit of a negative drag in the feeder market.
Jim, as well, looking at the energy complex, I know we've seen a rebound a bit in palm oil and crude oil. That helped out the bean oil market today, and I think it helped out a little bit yesterday as well. As you look over at the energy side, we continue to hear the talk. We've seen crude oil liquidate back a little bit, but still, we're well above $100 a barrel. What's your thoughts with energies here as we move to 4th of July? As you mentioned, we get more into this summer driving season. What is the impact of energies right now moving into the month of July on the ag commodities?
Well, I think in general, the energy market, I think will probably eventually start cooling down when we get to the latter part. I think you're going to see the consumer right now, Jesse, he's driving, he's been locked up after 2 years of COVID. He's going to start, I think the higher prices are going to start taking a toll as we get closer to the school time, later summer. And then on top of it, you got to, these high prices are bringing wells back online, not as fast as we'd like. But each week we do add a few more pumping rigs to the United States, portfolio, and you're also seeing it in the rest of the world. Now, with China coming out of COVID, that's probably going to help the demand near term potentially. But I think in general, the old line is high prices cure high prices, and I think you're going to continue to see the world ramp up production, and at these higher prices, you will start seeing a little bit of a drag on the consumption, and so it's going to take a little bit. Eventually, we will get back into balance.
Well, Jim, great stuff. Any other final thoughts you have for us here on this Tuesday?
One thing I can say, tell people is be prepared for a lot of volatility on Thursday. My recommendation, build your game plan now, call your brokers or call your cash merchants. If you want to sell some grain and you've got a price in mind, even if you don't think it's going to be happen, put it in there. This is one of those very weird reports, Jesse. We get two big numbers, and we don't know which way, and I know it sounds kind of funny, but we don't know which way the computer's going to read it first. I mean, the reality is you could get a very bullish quarterly grain stock number that essentially catch a bid, and the market surges, and then instantaneous, before you can even blink, the market breaks because all of a sudden it reads maybe the acreage number, says, well, the acreage number is negative or vice versa. You don't really know what's going to happen. So our recommendation is come up with a game plan of what you want to do. If there's a wish order, say, look, I want, if I can sell beans 50 cents higher, if I can sell corn 20 cents higher, get that order working, because the reality is that move may happen up and then back down before you even had a chance to even realize you had the opportunity to sell it. So build your game plan now. You got a couple days to do it, and be ready to get the orders working for the report. That'd be my recommendation.
Well, Jim, if producers need help building that game plan, I know they can reach out to you and the team there at agmarket.net very easily on the website, give you a phone call. You guys have a lot of resources to help producers, don't you?
That's correct. You want to reach me directly, 815-665-0461, or any of the Ag Market team members at 844-424-6758.
And again, agmarket.net, you can find all that information. With that, Jim McCormick, we appreciate the time on this Tuesday, sir. Have a great week. We'll talk to you again soon.
All right. Thank you.
Jim McCormick with agmarket.net here on Market Talk today. That's going to do it for the show on this Tuesday, June 28th. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.